Good afternoon, everyone. I'm Yuichiro Wakatsuki, co-president of Nippon Paint Holdings. Thank you very much for taking time today to participate in a conference call to provide an update on our medium-term management plan for FY2021 to 2023. It takes about 30 minutes for me to explain today. I would like to begin with an executive summary. To recap our progress, we are well positioned to achieve our medium-term plan target, and the year one of the plan provided the foundation for our asset assembler to deliver strong growth. I would like to take this opportunity today to explain our resilient model for pursuing MSV. Ryosuke and I were appointed as co-president on April 28, 2021. The two of us were involved in the formulation of the midterm plan. This has allowed us to swiftly implement business strategies based on the plan without much confusion. That is to drive an autonomous growth of each operating region and aggressively pursue M&A at the same time. After we became the co-president, we had sufficient discussion at the board of directors regarding the direction of our management policy. Our conclusion was to adopt a business model in which we, with small headquarters at the holding company, assemble assets focused on attractive paint and adjacency arena through M&A while driving autonomous growth of group partner companies. Effectuating strong growth with limited risk, we decided to call it the asset assembler model. The launch of Nippon Paint Holdings at the beginning of this year was based on this concept. The asset assembler model is not necessarily a change of management policy from the medium-term plan. Rather, we thought asset assembler would more clearly describe our sustainable growth model with MSV as our sole mission. Looking back on the first year of the medium-term plan, we delivered strong revenue growth despite the pandemic, which demonstrates the strength of the Nippon Paint Group's platform. That is, we are well positioned to capture strong demand, in particular in decorative paint, and a challenging environment such as the current one allows us to wield our strength in regions where we have high market share to drive market share gains. As we announced in our full-year FY2022 earnings forecast in February this year, we expect to achieve our Year 3 revenue target 1 year earlier. On the other hand, our profit was not satisfactory due to unexpected raw material price increases and supply chain disruptions affecting our business and customers alike. However, we effectively achieved operating profit growth, excluding one-off expenses driven by solid operating profit growth in Australia, Turkey, Asia except China, and contribution from the newly consolidated Indonesia business and significant savings of head office expenses with small headquarters at the holding company compared to the initial plan in the medium-term plan. I believe this is the evidence of our success as asset assembler in assembling excellent assets through M&A. Based on the operating profit result in year one, we maintained our operating profit target for FY2023. Despite various uncertain factors that are unfolding, such as the Ukraine crisis and corresponding raw material price trend, we see good prospect for delivering on our operating profit target due to revenue growth, underpinned by solid decorative paint demand and market share gains, coupled with margin improvement due to progress with selling price increases. We will continue to fuel our insatiable appetite for medium and long-term growth based on the asset assembler model after the medium-term plan period. This page lists the corporate actions we have announced since the start of the medium-term plan. There were concerns such as a possible slowdown of decision-making in early days after the launch of co-president setup, which is a rare management structure among listed companies. However, the two of us were able to deliver numerous corporate actions swiftly through very close communications with MSV as our shared decision-making criteria. Let me move on to explain the result of the FY2021. This page provides the revenue analysis, and we provided the volume and product mix breakdowns of the paint business on a trial basis to illustrate our revenue growth. The medium-term plan CAGR targets provided in the table on the right-hand side are the targets for FY2021 to FY2023 announced in March 2021. The revenue growth assumed for FY2022 is lower compared to FY2021, but is higher than the medium-term plan CAGR target. Just for your information, the growth rate for FY22 of Indonesia and Asian countries, excluding China but including Indonesia, is slightly higher than the guidance released in February. That revision was made, so please refer to that. This page provides the analysis of our operating profit. Looking at the operating profit bridge analysis between FY22 and FY2021, you can see that our revenue in Japan, China, and the Americas, our revenue in the US is mostly comprised of automotive coatings revenue, represented business one declined, while our revenue in Asia, except China, Oceania, and Turkey, represented as business two, increased even in challenging environments last year. Head office expenses increased from FY2022, but declined significantly compared to around 9.5 billion yen planned at the beginning of FY2022. This is the result from the small headquarters at the holding company I mentioned earlier. The contribution from new acquisition was 13.9 billion yen after reversing the one-off inventory step-up of 1.5 billion yen, and the forex impact was 4.4 billion yen. Adding one-off subsidies and deducting other expenses come to the operating profit of 87.6 billion yen on a Tanshin basis. A provision related to the project business in China was reported to be 3.2 billion yen based on the exchange rate applied in FY2020, but has been revised to 3.6 billion yen based on the exchange rate applied in FY2021. The effective start line of our operating profit in FY2021 was 94.8 billion yen, which was the amount obtained by reversing the one-off items of around 7.2 billion yen to the FY2020 operating profit 87.6 billion yen. Our roadmap for achieving the operating profit of 115 billion yen in FY2022 is through operating profit growth of around 15 billion yen. Aside from the contribution of around 5 billion yen from new consolidation of Cromology, coupled with the higher operating profit on higher revenue and margin improvement, this is our plan for FY2022. Assuming 10+% revenue growth of around 100 billion yen, excluding Cromology, we can expect operating profit improvement of 10 billion yen, assuming the operating profit margin of 10%, and the remaining 5 billion yen operating profit needed to achieve the FY22 operating profit forecast through the margin improvement of 0.5 points on a full-year basis. You can see that are well positioned to achieve our 22 forecast as measures improvement operating profit, and we are raising selling prices and reduce fixed, including head office expenses. Looking toward FY2023, we have maintained the operating profit target 140 billion yen. We can't provide the 23 guidance at this time. However, based on the 22 operating profit guidance of 115 billion yen, we need to improve operating profit by 25 billion yen to achieve the 23 guidance of 140 billion yen. We plan to achieve this through operating profit increase on higher revenue and margin improvement. The right-hand side of the page provides two possible cases. One of the combination of 10% revenue increase and 1 point margin improvement, and the other is the combination of 15% revenue growth and 0.5 point margin improvement. In either case, we can achieve operating profit of around 25 billion yen. The assumed margin level is lower than our initial assumption in the medium-term plan. Therefore, we'll aim to drive up the margin from the level. If we can add contribution from new acquisitions, and we'll certainly aim to do so, we have a good prospect for achieving operating profit for 140 billion yen. These numbers are strictly based on our desk plan, and but show good examples demonstrating our strengths as asset assembler. This page explains the strength underlining our unique asset assembler model. Firstly, Nippon Paint is focused on paint and coatings and adjacencies with significant market opportunities. These are areas where market is growing, and we have considerable expertise and knowledge. Secondly, paint and coatings and adjacencies markets offer low risk and good returns. We may not be able to expect explosive growth in these markets, but we can expect profit and cash flow generation with some degree of certainty. These characteristics make these areas suited to M&A. Thirdly, the Japan domiciled enhanced competitive strengths, the ability to obtain loans at lower interest rates, stability of currency, and support of financially sound Japanese banks give us competitive edges over our global competitors. Fourthly, the strength of an assembly of excellent talents and brand. We believe that our focus on paint and adjacency arena, which is characterized by local production for local assumption, makes it possible to generate greater than expected synergies based on our asset assembler model that assembles talent and brand, with each one individually outstanding. Although these synergies may be different from standardization and cost reduction synergies expected based on the US, European MA models. Fifthly, the holding company in Japan has established advanced and effective governance structure with independent director comprising the majority of the board of directors and exhibit strong commitment. In addition, the board of directors share a clear decision-making criterion of realizing MSV. This, along with the robustness of the concept of MSV, makes us competitive strength stand out among competitors. This page illustrates our asset assembler model. The key element of this model is that these excellent management teams pursue autonomous growth in the Nippon Paint Group, while at the same time proactively acquiring technological strength, distribution networks, purchasing ability, financing ability offered by the Nippon Paint Group platform, rather than at the initiative of the head office. This will create a synergy, and also will be able to welcome new partners. This will allow us to build up expertise in various areas, which will prepare us to attract new partners. By focusing on the paint and adjacent markets, which are obvious growth markets with high cash generation capacity, our asset assembler model allows to deliver accelerating growth with a limited PMI, post-merger integration risk of M&A. Now, I am going to cover strategy by region and businesses. As many of them have already been explained at the last conference call for FY2021 fourth quarter financial results, thus I will briefly touch upon that topic and spend more time on questions. The first topic is about raw materials market conditions, which generate concerns by many of you. We receive a lot of questions from many investors on this point. Our assumption is that the raw materials price will continue to increase until the first half of this year, and accompanied with the Ukraine situation, things are unpredictable, so that we keep making efforts to raise price, bearing in mind that wherever and whenever possible. The bottom right chart shows OP margin to be improved, along with the prevailing impact of a gradual price increase after bottoming up the third quarter of last year, and substantial improvement is hopefully achieved in around the second or third quarter of this year in times of peak demand. Demand in the fourth quarter is low. Therefore, it can't be helped but OP margin falls a Q-on-Q basis. Having said this, it is expected to be better year-on-year basis. From mid to long-term perspective, if an extreme level of inflation occurs, and also there is a lockdown impact due to the COVID-19, at the time of the guidance released in February, there is some improvement, but there could be some time lag as to this improvement. From the mid to long-term perspective, if we were to look into, if an extreme level of inflation occurs, it will certainly exacerbate economic climate that will have impact on paint and coating demand. However, the nature of painting business demand sensitivity towards price rise is not necessarily high. In addition, some regions and sectors are more advanced in terms of shifting to water-based paint, and this will mitigate the impact of soaring crude oil when compared with solvent-based paint. The second most asked question is revolving around China. First of all, regarding demand of paint as a whole, there are different perspectives which we understand. Paint consumption per capita in China, around 1/3 of developed countries. Urbanization is continuously advancing unchanged policy of the government to supply good quality housing to Chinese public still remains, and a huge demand for repainting centered on those private residences that were offered on a massive scale from the late 90s is recognized. With those factors taken into account, the Chinese market offers a promising good market with growth potential. In addition to GDP plus alpha. On top of that, the market is changing dynamically. Therefore, our Chinese team has been always on alert not to miss any change and take actions actively by looking ahead the market at all times. The stance will not change moving forward. Our strategy is to enhance competitive edge by elevating value add as a solution provider, not just improving user experience, expanding product portfolio, and selling paint and coating products. I will not cover page 14 and 15 because I have discussed the Chinese DIY and project. However, I would like to call your attention that updated market share numbers from those announced the investor briefing on the Nippon in September 2021. In particular, the market share was estimated as 33% previously, but it stands at 27% now. The numerator remains constant, but the denominator has expanded as repainting demand and rural markets are now incorporated. That is the rationale behind the change. This reveals some part of dynamism of the market, but it also indicates there is still room for further expansion of market share. And now, page 16, with respect to the Dulux Group, the company has achieved a very stable growth among other companies of Nippon Paint, and this trend is expected to stay. If I may add one comment, with the backlash of the rise driven by stay-at-home demand due to COVID-19 2022, even though a decline in retail market is observed, the DJR or Dulux Group delivered robust growth in 2021. DJL team led by Pat Houlihan, CEO, has been gaining considerable credibility, and both Chronology and Yube, which will be newly consolidated, FY2022 will surely grow this year as well. Having said this, given the backlash of COVID-19 related special demand, a small drop in the first half vis-a-vis the previous year is expected, but a year-on-year growth starting from the third quarter to the fourth quarter of 2022 is expected. This is the story that we assume. As for the Betek Boya in Turkey, under the radical change in the environment, Betek Boya team has acted in an agile manner. As a result, they gained the market share and achieved growth in profit in the midst of rampant inflation. Under such inflation, demand is brought forward, but Betek Boya will keep expanding aggressively. Having said that, given the plunge of the Turkish lira, when the currency translates into the yen term, inevitably the contribution of the company will be lower. Next, Indonesia. Looking at the business in Indonesia, Indonesia business grew at a solid rate of 25%, even though there were impacts of COVID-19 in 2021 and lockdowns in the third quarter. Forecast of mid and long term slightly conservative, but operating profit and growth are expected. Now, based on the information disclosed in IPO prospectus of Indonesian paint manufacturer in 2021, our market share is the second largest following the local paint manufacturer. So the current share is 70%, which is the farthest down such a figure, but we are taking some measures. Conventionally, I'd like to say that the Indonesia was the first rank, but I would like to make effort.
The Japan segment is... We received many questions about the Japan segment. Japan has been in a challenging situation for the past 2 years, as the automotive coating business accounts for a large percentage of the Japanese segment, and the decline in production at customers due to the pandemic has caused our revenue to decrease. This has been further compounded by the rise in raw material costs. In addition to fixed cost reductions as part of our corporate efforts, as we realized additional measures were necessary, we have been forced to raise prices in Japan with the understanding of our customers, and we have been doing so since the latter half of last year. For example, in the case of automobiles, we believe that the end demand is strong, and once the automobile manufacturer's production recovers, we believe our revenue recovery is fully possible. Speaking of automobiles, in addition to the recovery of production by our customers, we will continue to differentiate ourselves from our competitors in the future by leveraging our technical capabilities to respond to environmental issues. In particular, as the trend toward carbon neutrality accelerates among our customers, we plan to develop low-temperature baking energy-saving paints and an environmentally friendly film business in order to reduce VOC emissions from the paint production process. For example, our film technology can be applied to other areas such as construction use. Final topic on business strategy, the progress in the paint adjacency business. This is a huge market for both SAF, sealants, adhesives, and fillers, or construction chemicals, CC, globally. Like paints, market growth is expected to be driven by construction demand. In addition, SAF and CC are brand-based businesses that do not require heavy capital expenditure and can share many of our paint distribution networks. Therefore, we believe that it is a very promising market. Again, we did not start from scratch in this area. With the acquisition of Dulux Group, a very profitable adhesive brand called Celis joined our product line. We distributed this product through the Asian Nipsey distribution network, which made the Asian business profitable, although they have had deficits. This is only part of our different experiences we accumulated through such endeavors. Based on this experience, we were able to acquire Vital Technicals in Malaysia, and Vital Technicals has achieved significant earnings growth since the acquisition. Betek in Turkey has been dealing with construction business, and this business has high share and high margin, so we are now considering rolling out of these businesses in Europe, following the recent acquisitions in Europe. It is important to note that our model enables partner companies to leverage each other's resources and capabilities mutually and pursue growth hungrily, insatiably, without any direct involvement by the holdings companies. From here on, let me explain about the sustainability strategy. First of all, regarding the structure, we rejuvenated the structure. So we strengthened the link between sustainability initiatives and businesses even further to realize an autonomous team composition. And again, this initiative was not led by the head office. 4 global teams were established based on different materiality, reporting directly to the representative executive officers and co-presidents. 4 team leaders will lead each team and will drive the initiatives on a global basis. Let me add some comments regarding sustainability-related governance. Each leader reports directly to the co-presidents, including myself, and we report the progress of and proposals from the teams to the board of directors whenever necessary. This means that board of directors will supervise the sustainability initiatives. So we will use 2 slides from here to explain the progress with each materiality. We identified the materiality in 2020 and presented risks and opportunities stemming from each materiality in our integrated report of last year and have taken actions associated with those risks and opportunities. Regarding climate change, we started the disclosure in accordance with the TCFD final report recommendations last year, and we agreed with each group partner company regarding the target formulation in order to achieve net zero CO2 emissions. We will touch upon the specifics initiatives later. We have already begun renewable energy utilization as well. Please see the bottom row of this page for safe people and operations. Regarding diversity and inclusion, we realize that human rights policy formulation and risk assessments are necessary after sharing the situations in each operating country and region. We will now move on to the implementation phase from this fiscal year on. We will also drive initiatives to aggregate data regarding human capital, as human capital management disclosures may become mandatory or a legal requirement. Growth with communities. We quantified and disclosed the social contribution activities in order to define the link between sustainability initiatives in the community and the businesses. We plan to step up these activities from this fiscal year onwards. As an example, to create innovation to address products through cross-functional to address social issues, we have developed and sold antiviral paint products through cross-functional efforts across the group. We will strengthen the control of chemicals of concern and step up initiatives in the areas of high social concern, such as life cycle assessment. Let me share with you some specific initiatives. The first one is net zero CO2 emissions. Initiatives in each operating regions will be shared mutually and will drive future activities on a group-wide basis as we learn from best practices in different regions. For example, the Nipsey Group reduced its carbon intensity by 15% in 2021, utilizing renewable energy by installing solar panels and by practices to save energy. Dulux Group has its own original target to achieve net zero carbon by 2050 and to achieve 50% renewable energy consumption and 50% carbon reduction by 2030 as an interim target, and is on its way to achieve this commitment by driving the initiatives. Dunn Edwards in the US is studying the possibility to introducing renewable energy at the new corporate office. Japan started to procure renewable energy, and the Osaka head office achieved 100% renewable energy consumption in 2021. This slide shows you that antiviral paint products have been launched one after another from fiscal year 2020 in the operating countries of NIPSEA and in Japan as examples of our innovation. Our group will continue to work together to develop and sell products that will contribute to the solutions of the various challenges of the society. I will now walk you through the M&A strategy. I will refrain from describing specific target names and target geography, yet we have not changed our strategy to focus on businesses that can contribute to EPS accretion in year one following acquisition and offer attractive risk-return profiles in order to contribute to MSV without any limitations to category of business or geography. As I have stated earlier, our model is not based on the so-called global standardization or common cost reduction synergy program. We invite excellent companies which has the potential to consistently contribute to EPS and encourage them to pursue autonomous growth as we offer financial ability and accommodate them in an environment to enable collaboration with companies around the world on the Nippon Paint platform. We believe that this model of ours will lead to a value creation in a medium to long term in the paint and adjacency business, which is characterized by local production for local consumption. You will find some M&A best practices that showcase our approach in the next 3 pages. As they are relatively self-explanatory, I will refrain from going into the details. Several cases of adjacency business M&A which has not been disclosed so far are included in the second page. The amount of acquisition may be very small, yet this is how we accumulate expertise in the adjacency area. Page 34, this is the financial plane. Regarding financial leverage, as of the end of fiscal year 2021, it was before the closing of chronology closing, so ND/EBITDA multiple was 3.4. Our current assumption at the end of FY22 is a multiple of 4. As it says on the right side chart, all the funds are basically procured in yen base. Average term to maturity is 5 years, and average interest rate is before tax is 0.4%, extremely stable debt structure. We have always believed and have shared with you that a leverage higher than the chemical industry in general can be applied to the paint and coating business without impairing the safety of the company. This is why we do not establish a limit to the leverage. We intend to continue to proactively execute significant M&A without setting the upper limit on leverage. On top of driving growth in FY 2023 and beyond. Yet last year's operating cash flow were lower than expected due to a decline in margin and increase in working capital attributable to stable procurement of raw materials. This is why we are determined to review the cash conversion cycle in various operating regions this year. Lower right, our industry does not require a large capital investment to begin with, but we will carefully select investments that will lead to future growth, mainly investments to increase capacity in Asia, China, and other regions, with the exception of Japan, where investments are basically focused on renewal and maintenance capital expenditure for aging facilities. Chromology's figure is included in the others category in 2022, and the majority of the 5 billion yen will be that of Chromology. So page 35 shows operating profit in different operating regions shown in response to your request. I hope this will be useful. Before I close the session, I would like to recap the points I would like to convey today. Number 1, we expect to achieve our year 3 sales revenue target of the medium-term plan 1 year early. We'll maintain the operating profit target. We'll continue to aspire to achieve operating profit target through revenue growth and margin improvement. Number 2, Nippon Paint will continue to fuel our insatiable appetite growth as a unique Japan-based asset assembler with MSV as its sole mission. I mean growth of profit. Especially this second point the policy as the asset assembler, which I have mentioned repeatedly today. We will thoroughly implement this policy of respecting the characteristics of the local business, autonomy of the partner companies, eliminating bureaucracy from the small head office, assembling excellent companies, human resource, talents, brands, focused on growing markets of paint and adjacent business through M&A. By doing so, we will do our best to achieve continuous profit growth while minimizing risks and thoroughly delivering on MSV. We deeply appreciate your continued support to the Nippon Paint Group. Thank you for your kind attention.